Good morning, good afternoon, good evening, folks. Michael Zuber, one rental at a time, back with the one and only Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
So, it's something I wanted to ask you because I'm starting to see more and more comments in my YouTube feed about a Fed pivot. And anytime I hear the word Fed pivot, I always ask people to define it. Is a Fed pivot a slowdown in rates? Is it a pause? Or is it a cut? And I'm actually seeing more and more people call for a Fed cut in Q1 of 2023. So I wanted to ask you, A, do you think that's possible? Actually, we'll just start there. Do you think the Fed will cut rates, the Fed funds rate in Q1 of 2023, either at the February or the March meeting?
So anything is possible, but that's not very likely or probable, even as ridiculous as they've been so far, denying inflation, continuing to deny inflation. But I just don't see how that's possible given the environment we're in right now.
Yeah.
And the only, you have to ask yourself, what would trigger that action?
Yeah,
And
that's
the only thing
exactly
that would,
part B. Yeah.
yeah, the only thing that would trigger that would be, a major, huge economic event in some form or fashion that's taken down the markets and taken down the economy, like a pandemic or something like that.
Yeah, it would have to be, I mean, again, it would have to be something out of left field. Cause I mean, when I think about the economy and the Fed, and I've been studying this for over 3 decades, in order for us to get a Fed rate cut in February or March, which are the two meetings in Q1, even unemployment, right? Unemployment doesn't move that quickly. We're at 3.7. Even in extremes, it goes to 4.7, like a full point in 90 days. That's not going to cause the Fed to stop. If we just had a jobs number of 263,000 created. Even if we went negative 200,000 January, February, March, I don't think the Fed cuts. I think the Fed pauses. Sure, that if you want to call that a Fed pivot, I think a Q1
Yeah, but that's
pause makes
not a
sense.
pivot. Just to be clear, a pivot
Yeah,
is the Fed
cutting.
reversing and cutting
Yeah,
rates. That's a pivot. A
I
pause is
agree.
not a pivot. A
I
slowing is
agree.
not a pivot. That's a narrative on Wall Street that the markets are
Yeah.
perceiving. That's the
Yeah.
new pivot. But a
Yeah,
pivot
exactly.
is
Let me define it.
reversing course. It's like
Yeah,
pivoting, reversing course, and cutting
I
rates.
agree.
So
Yeah.
that's very different than what they're already said that is possible. And look at how the markets reacted to that.
Yeah.
It's possible that we could
Slow
slow
down.
the pace of rate hikes, which means 50-50,
Yeah.
50 this meeting, 50 next meeting, but that's all going to be dependent on the inflation report that comes out next week. And,
Yeah.
I
Yeah.
don't know if we're going to talk about that or not,
Yeah,
but
we can. We might as well because this is what I see. So I don't think a Q1 pivot, meaning a cut, is very likely. It's in the order of a black swan, like Lehman Brother, just really bad stuff. And I just currently don't see it. But like you say, anything's possible in this world economy. My current thinking about the Fed is we're going to a terminal rate of 5. So we're going to get 50 on the 14th. We're going to get, I think they go 50, 25. I think they become Greenspan or Bernanke, whoever it was. They're just going to kill us with 25s. They're going to go higher than the market expects, and they're going to go slower. So 50, that takes us to 4.25. So 50, 25, 25, 25 pause. So I don't think we pause until like June. That's what I'm
yeah.
currently thinking.
Yeah. Well, the Fed whisperer, Nick
Yeah.
Tim, Timonis, whatever, from the
Yeah.
Wall Street Journal, he's
Yeah.
the
The
guy
guy who
that,
gets tweets. Yeah.
yeah. So, he's obviously got some inside information. So right now he's saying 50-50. That was as of the last Fed meeting and all that. So we got to see where the inflation report comes out. If there's going to be anything other than 50-50 or just 50 at the next meeting, we should be hearing about it this week. The Fed doesn't like the surprise, but if they get a bad inflation print, they'll come out with 75 and they'll be like, we really don't care about the markets. They haven't said a word about anything other than inflation. They don't care about the
Yeah.
job market. They don't, they want to see weakness in the job markets,
Sure.
and the job market is not giving the Fed what it's looking for. And even how that's being reported, that's questionable in terms of how they're measuring all of that and whether it's accurate. And one household having multiple jobs is counted as
Yeah.
one.
Yeah. It's
So it's
weird.
it's all
Yeah.
messed up. The bottom line is we know that there's more jobs available than people taking them, so that's a problem. It should, needs to be the other way around to fix inflation and to drive wages, or plateau, get a plateau in wages, which, wage increases are a good thing, but
Yeah.
people are spending it, so that's where this
Yeah.
balance needs to come in. And that's why I'm talking about we could be at much higher. And the other thing is the Fed fund inflation's never been they've never been able to affect inflation or bring the rate of inflation down without going higher, the Fed funds rate higher than inflation. We're not there yet.
Bingo.
We're nowhere. We're half.
No, we're
Inflation is
half
still
that.
8%. You
Yeah,
know, so
I agree.
I mean, until you get inflation down to 5 and the Fed funds rate above 5, then you can really expect to affect that. So, I mean, it could be years before anything like that happens. And, you know, again, the only thing that could cause a Fed intervention would be some sort of a accident in the markets. And even then, I don't think they're going to bail Wall Street out until it loses another 30 or 40% from where it's at.
I agree. Yeah, I agree.
Before that gets their attention. And, you know, if you get a banking crisis or something like that, they might step in and do something for the banking sector or for the bond market or for, you know, different things like that. But they're not going to just come in and juice the stock market, you know, with quantitative easing or with a Fed pivot. Now he's going to talk and give the market, you know, a little bit of juice like he did last week. I kind of think he had something going on the side where he threw somebody a little bone, you know.
Yeah, exactly.
Needed to get out of it. Somebody needed to get out of a
puts.
position.
You never know. Yeah. So I think,
dude, I'm about to get liquidated. Can you just mention that there's a possibility?
Yeah. Let me protect me. Come on, man. We went to school together. Yeah. You never know. So I think if someone were to ask me, do I see any Fed cuts next year? You know, my answer today is no. I think they get to some terminal rate and they just hold it there. I think the Fed has been remarkably clear, but there are so many people conditioned to think the Fed is going to just bail out. I mean, for 40 years, the Fed put has existed for a reason. They have bailed out Wall Street. I don't think they're coming unless, to your point, it's a 30 or 40% decline from here.
Or if they can. So inflation has to come back down. Economy's got to really slow down, you know, all of that kind of stuff. And then they can. So right now,
I don't think it moves that fast. Your kind of video one, I think there's two components of the three that are hard, and we're going to be stubborn for a while.
Yeah. Yeah. Interesting. It's fascinating times.
Yeah. And then I guess we'll talk about, the stock market. You know, I think one of the things that we could have next year besides a global recession is we can really have an earnings recession. I think Wall Street analysts starting in Q1 are going to be cutting earning expectations. I think the average for the S&P is $238 for next year. I think they have to get closer to 200. And then the PE ratios need to adjust as well. What do you think about an earnings recession next year?
Yeah, that's the thing the market hasn't priced in. It can handle interest rate risk right now and inflation risk right now, but it can't foresee that, and it hasn't priced that in. So that's the next leg down in the markets. Once we get through this year, and here's what's happening this year. Okay, there's always a Santa Claus rally. Why? Because Wall Street needs to get their bonuses. And there's already news out that Goldman Sachs cutting bonuses, you know, the other banks.
At least 10%. Yeah.
Right. So how do you get a bonus? You got to have so the way you make money on Wall Street is being ever bullish. Okay. No, bears don't make money on Wall Street. That doesn't attract capital. Bullish attracts capital. Tom Lee, Cathie Wood, they're still in business because they're,
I can't believe Cathie Wood is still getting funds. It's crazy.
Yeah. Well, you know, I mean, it's that bullish narrative until it's not. And the markets have held on, even though they're just higher highs, lower highs and lower lows, that it's putting in. So how do you hit your bonus on Wall Street? You drive the market down, you go test those October lows, and then you blast into the end of the year with this huge Santa Claus rally. Everybody gets their bonuses, and then January, bam. And if you go look at last year, that's exactly what happened. In the last couple of years, you kind of see the same thing. Market gets driven down right about middle of December. Then you get this little Santa Claus rally, and then January, February, in these environments. And go back and look at 2008 and 9, what happened then, 2000, 2001, what happened then, same kind of thing. So, that's kind of where I see it. But yeah, they can't price in the recession and the effects of recession on earnings because it hasn't happened yet. Yeah. So we haven't seen real earnings take a hit because it's holiday season. Everybody's spending money. Everybody's looking good, and they all, have these positive outlooks. But certain segments of the companies out there have all just look. We're not putting any forward guidance out, and it's all such a game, anyways, because they know what they can do, and they put numbers out that they know they're
going to wait. They're going to wait till January. They want to get through getting their checks.
Yeah, so it'll be interesting. I mean, that's what I've been saying. We're going to get a lot more information Q1, Q2, next year. And if we can see the bottom start to get put in, it can be during that period to where we can start to maybe stabilize and then look for a rebound after that. But I don't think we're going to get there till we get into Q1, Q2 next year. And,
Yeah.
a lot of it's going to be based on what we see of, earnings at the end of this year.
Very, very cool. Well, Greg, do me a favor. Where can people find you?
Yeah. GregDickerson.com.
Thank you so much.